So in only about 6 weeks, the total amount of negative yielding debt globally has gone from $13 trillion to $15 trillion. It seems like it was only a couple weeks ago that I was doing another live stream talking about the $13 trillion in negative yielding debt. Now I have up the chart here for you guys to take a look at, courtesy of Bloomberg. Basically, the chart has gone even further parabolic. Remember, if you take a look at the $13 trillion chart, I'll attach a link to the old show from June 20th or June 24th, but I think the articles were coming out on June 20th or June 21st, how there was $13 trillion worth of negative yielding bonds globally. And that chart was parabolic. And this chart now, even though we are now over 15 trillion, is still parabolic. So the curve is ascending. Just crazy stuff. This negative yielding debt globally now, I would say it's growing faster than the US's national debt. So yields are dropping. The US Treasury yield, the 10-year US Treasury yield, just in the year to date, it's down from like it was as high as 2.78% on the 10-year US Treasury, and it's down to 1.73%. So the US is not negative yet, but recently the entire German yield curve, all the boons, are now in negative territory too. Just insane stuff. And more comments as well from other central bankers. Let me pull this up from this. I have a couple articles for you guys to read. I have a Bloomberg article, a CNBC article, and let's see here, and a good article with a number of key tweets and analysis from Mish Shedlock of MishTalk, moneymaven.com, moneymaven.io. It's got a weird web there. So let's talk about the other central bankers. So the Reserve Bank of New Zealand aggressively cut its benchmark rate by 50 basis points to 1%. The market was only expecting 25 basis points. Quote, "It's easily within the realms of possibility that we might have to use negative interest rates," end quote. And that's what the New Zealand New Zealand central bank governor said. Wow. So all these guys, they all have pretty much the same playbook, and they're all going to the Japan playbook. And this is why I talk about financial repression, Japanification, interest rate repression. And I talked last week, remember, about the Wolf Richter article where he actually ran the math, and he was talking about just in the US alone, his estimates that if 2% interest rates are stolen on $40 trillion worth of bank accounts, worth of savings accounts, checking accounts, bank accounts, CODs, and bonds, that Americans or other investors here into the United States are having over $800 billion per year stolen from them with a simple 2% theft of interest rates. And this is why so many of my listeners are looking for income now, because not only are they getting killed with higher inflation and taxes, but their income is also that they used to be able to get for safer investments. That income is gone. It's being taken away, siphoned to governments. So governments do not have to do big cutbacks. Quote, "Bonds are supposed to pay the owner of capital something to pry the money out of their hands, and that's no longer the case." That's from a co-founder of DataTrek, Nicholas Colas. You know, this is just ridiculous. We are in the Twilight Zone. We are in the bizarro world, theater of the absurd, welcome to dystopia type of territory. What's up is down. What's left is right. What's inside is out. We are in that type of theater of the absurd now. If you would have told me 10 or 12 years ago when I was just learning investing and finance, all the crazy shenanigans that the people in power would pull to buy the global economy, another 12 years of 12 years of zombification after the 2008, well, we're not 12 years yet, but a little over 10 years of zombification after the global financial crisis, I would have said I wouldn't believe that they would get away with it, and yet they have. So just freaking nuts. A really good listener question when I posted some of these $15 trillion global negative yielding debt articles in the Wall Street for Main Street Facebook group, a smart listener asked a common sense question that I don't think that people in power either know or care, that why would people buy this stuff if it's negative yielding? And the answer is a lot more simple than you think. Okay, if you're not in the financial industry and you don't understand the financial industry, you probably wouldn't understand this, but a lot of it has to do with the requirements, if you're a bond manager, a bond portfolio manager, that you cannot go to a lot of cash. So you may hold a lot of these either bond mutual funds or some of these other professional money managers. They may be allowed to hold up to 10% cash, but normally a lot of them don't even hold that. So they are risking their career. They are risking getting fired if they're a bond fund manager and they don't own bonds. So even if the bonds are garbage, even if they're losing money, even if they're not getting any income for their investors, they are hoping, like, I guess, Stanley Druckenmiller, that they will get an increase in principal, which is really funny because bonds are not supposed to increase in principal. Bonds are supposed to be for income. They're supposed to be for more safe and reliable income. And the what has happened now with turning everything on its head is a lot of people are now invested in stocks for income, for dividend yield, and that's risky, and then they're in bonds for principal increase, which in the past, it used to be the exact opposite. For many, many decades of finance, this has never been the case, and now here we are, a lot of people are doing basically the exact opposite of what has been done in finance for a long time. Just crazy stuff. So certain pension funds buy a lot of bonds. Some of them feel like they're required to buy a lot of bonds. Insurance companies are, especially in the United States, I can't speak for European insurance companies, but American insurance companies are required in state laws to hold a lot of bonds for liquidity purposes. So when they collect premiums from people who pay insurance, the float a lot of it gets reinvested into bonds. So you have professional money managers and bond funds who are not allowed to hold a lot of cash, and they're holding their nose and they're looking to the guy left and to the right, making sure those guys are buying bonds too. Because if they just copy the other people who are managing money, normally everyone won't get fired. Although if they go to indexing, then those guys are going to get fired anyway. I just read an interesting article about indexing. I think there's like over $74 trillion in money under management that's actively managed that could lose their professional money managers. Big cutbacks are straight up firings for indexing just in the next few years. So just insane stuff. And on top of that, guys, not only do we have negative yielding government bond debt, we have negative yielding corporate bond debt. There's at least 14 European junk bond debts that's negative yielding. And a Danish bank, one of the largest Danish banks now, has a mortgage. They're offering mortgages at 0.5% negative interest rate, meaning it is basically paying people to borrow money to buy a house. I can't make this stuff up. If you would have been in finance 20 years ago and you were writing these articles or predicting this stuff, they would have laughed you out. You would have been fired. They would have said this is pure fiction. And yet here we are. Just totally ridiculous stuff. The people in power, the governments and the central banks and the academic economists have just turned the world upside down on its head just to buy us another decade. Freaking nuts. Oh, one other thing before I talk about more stuff in the show here. So a number of my listeners who listen to all the podcasts, apparently they don't check the information and description section under the videos. And I do have a Patreon. So some people are not aware of this. It's patreon.com/Wall Street for Main Street, WALLSTFORMAINST. I have 74 patrons now. I had for a while, I had 30 people about cancel. But it looks like I've gotten pretty much all of them back. Thank God. So that money will hopefully be reinvested into other parts of the business going forward. If I can get even more patrons to contribute maybe $1 a month, $5 a month, $10 a month. I've been getting a lot of $5 and $10 a month. So thank you for all the 74 patrons who have either just signed up or stuck with me. I really appreciate it. It's going to allow me to grow my business and hopefully, bring you guys better content and hopefully upgrade equipment in the future and do a lot of other interesting things. Maybe even go to some conferences and get some interviews that way. We'll see. So that was just a plug for my Patreon because apparently I wasn't aware of this because I put under the information and description section of every single one of my videos that I have a Patreon, but there was a number of people hit me up on Twitter that weren't aware that I have one. Oh, thank you for promoting, Sean, the enthusiasm to hit the like button. keep it low on the cuss words, guys. I don't want people reporting us. I don't want to comment on the Jeffrey Epstein stuff here on this live stream show. We'll keep it to the financial information for now. So the chart here, if you look at this chart, man, it's going crazy. If you're not familiar with the makeup of the 16 trillion, of the 15 trillion, it's a mix of government bonds and corporate bonds. So a large chunk of it for now is still in Japan and still in the European Union for now. However, like I said about the U.S. Treasury, there are a lot more people inside the Federal Reserve and academics who advise the Federal Reserve and write research reports that the Federal Reserve reads, including people at the IMF, people at the World Bank, people at the Bank of International Settlements. I know the IMF just put out a pretty extensive research report talking about why there needs to be more negative interest rates. I think the report is free now. One of the other big agencies, it could be the World Bank or one of the others, was charging for the report, but I think the IMF one is free. Why the global economy needs to head to cashless society and also negative interest rates. Just great stuff. Of course, I'm being sarcastic. So even like 3 or 4 years ago, there was not a lot of people in the Federal Reserve, the economists there, and there's over 3,000 PhD economists inside all the different Federal Reserve locations. There was not a lot of economists who wanted negative interest rates, and that tone has changed a lot just in the last couple years. Hey, Sean, they don't have a lot of diversified cash flow. I think they have one royalty or stream online, and it's on a mine with low reserves. And they've overpaid. This is just my opinion. They've overpaid. They have to dilute shares on all their deals, and they have to overpay. They've been overpaying on all their deals. Albert says the U.S. Treasury is out of money. Yes, and that's why the Federal Reserve is going to start quantitative easing. But you know what? That doesn't mean the dollar is going to collapse. Because you have all these other governments all trying to go negative yielding debt, cut interest rates, perhaps go negative on interest rates if they're not negative yet, and do quantitative easing. Look at what the European Central Bank is doing. The European Central Bank has done a massive amount of QE in the last 3 or 4 years. Albert, all these major governments are broke. The European Union, Japan, the United States, China, they're all in trouble. If you're a trader, you're betting on which country collapses first, and that's the trades you're setting up. If you're not a trader, then you don't make those bets. Sean, this is just my opinion. I do not like any of the precious metals royalty and streaming companies smaller than Sandstorm Gold. And that is because you have to achieve scale with real diversified cash flow. Now, if the gold price goes high enough, those other smaller companies will go up, but they have to dilute a lot of shares to do deals. And they've been overpaying on all their deals. All of them. Even Mavericks Metals and those guys. All those smaller ones have all been overpaying. You have to achieve a certain amount of scale and a certain amount of diversified cash flow annually to have diversified cash flow coming in to plow back into the business to get good return on invested capital and increase return on equity. And at that stage where those smaller companies are, in my opinion, I think even Mavericks Metals is too small for now. They only have about 25,000 gold equivalent ounces, so that's not enough to do add on a lot more cash flow deals without dilution. Deflation before inflation. If deflation does happen, if asset price deflation does happen, so asset prices are allowed to collapse, my educated guess is that would only happen for maybe 12 months, because then that would make U.S. federal government capital gains tax revenues from stocks, bonds, and real estate collapse, and that almost totally blew a hole in the U.S. Treasury budget in 2008. The U.S. Treasury, I believe, had a 20% gap down loss in capital gains taxes, and that's why all that intervention was done with QE and rules changes to try to move the stock market back up. A 20% or more loss in annual tax revenues and capital gains taxes is significant. It used to not be that way, but a lot more and more of the annual U.S. Treasury budget is based on capital gains tax revenues. So if there is a collapse in asset prices, I would not expect it to last for more than about 12 months. That would be my educated guess. This is not financial advice. And I would plan things accordingly, which means you want to have some cash on the sidelines for opportunities, just in case some of the best companies and assets go on sale. And this is how people like my friend, like Dr. Mark Faber and others, made a lot of money in real estate. He had cash. He went in and bought rental properties in Atlanta. He went in and bought rental properties in other parts of the United States. He was buying stocks when there was blood on the streets in 2008, 2009, and also rental properties. But I don't think that will be allowed, because we're in a system that, first of all, the ideology of all the economists in power, they won't allow real deflation because real deflation cannot be taxed. And secondly, if the asset prices fall, then things look even more insolvent. And then the pension funds are even more insolvent. Actually, I don't know if I call the pension funds insolvent. The pension funds have, like, CalPERS and CalFERS have like $1 trillion in assets under management. They just are very underfunded because they have assumed that the politicians made promises of like 8% compounded annual growth rate returns in order to fund lavish retirements of 80% of salaries for the highest earned salaries for a lot of government employees, teachers, firemen, policemen, etc. Exactly. Pension funds are overpromised. And it was done that way by the politicians to buy votes. Most politicians knew that the math did not work. Okay, let me check to see if there's a couple more things on the articles I want to talk about. So there are now, according to Charlie Biello, let me see who he is. Let me open up. Mish has him in his article. Okay, he's an investor with a lot of Twitter followers. I've never heard of him, but apparently he has a blue check mark and 120,000 Twitter followers. I guess he's like a Wall Street trader. There's now negative bond yields through 50 years in Switzerland, 30 years in Germany and the Netherlands, 20 years in Denmark, 15 years in Japan, Austria, Finland, Sweden, France, and Belgium, 10 years in Slovakia, Ireland, Slovenia, 8 years in Spain, 7 years in Portugal, 5 years in Malta, 3 years in Cyprus, 2 years in Italy, and 1 year in Bulgaria. Just freaking nuts. And as bond yields drop, the value of bond yields increases. The bond bubble keeps inflating. The value of global bonds has hit a fresh high of almost $55.3 trillion as global central banks concertedly are cutting interest rates. So this looks like a bond scheme to manipulate bond prices higher, but steal all the income from people. Michael Leibowitz, my buddy Michael Leibowitz, shout out to him, friend of the show, friend locally, have lunch with him every couple months. He says globally coordinated monetary policy is morphing into globally competitive monetary policy. From a macro perspective, that may be the most important concept investors must understand. And this is beggar thy neighbor. The competitive monetary policy is beggar thy neighbor, competitive devaluations of currency, the race to the bottom. And this is what happens when all countries are off gold. Gold worked. Gold worked for a long time, but governments, it's harder for them to cheat. Governments who don't have gold don't want gold. So that's why governments don't want gold. It's easier for them to cheat. And that's why you have now, when all these countries are off. This is by the way, I forgot to mention this, I think, in the last live stream show or two. I think with the currency war, Jim Rickers, I forgot to mention this one. This one, important tidbit. This is the first time in world history, after 1971, that in modern world history, that every single government is off gold. There has always been at least one government on gold throughout history. And this is the first time that we are not on gold, that there is not one government on gold. And I think the US dollar has been off gold unbacked since 1971, so that's about 48 years. So 2019 minus 1971, it's about 48 years off the top of my head. Normally, fiat currencies that are unbacked and are abused normally only last about 40 years before they collapse. So we're getting to that end game point here. The timing of this thing is tricky. If I was managing money, I would be setting up hedges. A lot of people are going to lose, have already lost a lot of money timing things. Look at how many people have bet against Japan and lost. There's been a lot of people that have leveraged up and bet against Japan and lost. That's been called the Widowmaker trade. So timing these things is very, very difficult. And the reason is because the governments change the rules and they intervene and they manipulate markets. And a lot of these larger governments get away with it. If you were short the Chinese stock market last year in November, you got a crash, but then the Chinese government came in and did $800 billion worth of quantitative easing, and the stock market rallied. How would you have, if you were short that and you had done your research, how would you have known that they were going to come in and do that much quantitative easing? So to be a professional short seller, it's not a smart idea to be a long-term professional short seller. Not in this environment where the major economies, the governments, the central banks can all change the rules, and the incentive structure is in place to, at least in nominal value, increase asset prices. Hey, Robert, it was a sovereign wealth fund to bail out a Chinese bank, and I use the analogy of how that's similar to a pension fund. The difference is that the stewards of the pension fund could have been sued, and the investors in the pension fund, the people whose retirements are in there, could have voiced their displeasure at the bailout. So it probably, if there would have been an attempt to buy that bank here in the US, there would have been bylaws in place preventing that, or the pension fund managers would have been fired, or there would have been countless amounts of lawsuits. But the Chinese government just arbitrarily decided that we're going to use our accumulated savings that they've stolen with the dollar peg. By the way, if you're not familiar with the dollar peg, the Chinese government has siphoned off the wealth for itself with the dollar peg, running the trade surplus. The individual Chinese citizens should have gotten the benefits of an increased RMB currency instead. So the dollar peg has actually not been beneficial to a lot of Chinese citizens. It's actually stolen a ton of increased purchasing power. The individual Chinese citizen should have gotten the benefit of that from China producing all of those years before the credit bubble. So the dollar peg is, hopefully those pegs will break. We'll see what's happening. Kyle Bass thinks that the Hong Kong dollar peg will break first. We'll see what happens. He's laid out an extraordinarily good case, I think. Hey, thank you, Kevin, for the super chat. I appreciate it. Every little bit adds up, man. Hey, if I could get another couple dozen people to each chip in $1 per month on my Patreon, things will really start to improve. A few dozen more. Things would start to roll again. Look, I know times are tough for everyone. I had 30 cancellations on my Patreon in the last year, but now that number seems to be back up. But look, I had to make more than 5 times the amount of content in the last 2 months. I had to post basically every day, sometimes every 12 hours, to get the numbers back up to what they were 3 or 4 years ago without doing this much work. Pretty nuts. But I think I figured out how to beat the YouTube algorithm. You just have to post a lot, and the content has to be good. It is a lot of extra work, though. Okay, guys. Well, I think we're going to get to way above $15 trillion. And I think it's increasing. If you look at the angle here of the upward trajectory, it was going parabolic at 13 trillion. And now it's going at a higher, steeper angle now at 15 trillion. If you look on that chart that you can see on your screens. So this trend is not going to stop, guys. This is how the people in power think that they can maintain power or gain more control over us and also steal income from us. It's sad. I literally hear from everyone that they need more income. There's very few people I do not speak to. I don't give them financial advice, but people just tell me, man, my bills are going up. My bills are going up. I own physical gold and silver. I own some Bitcoin maybe. By the way, I'm not a Bitcoin pumper like the people in the gold community are claiming. I'm getting emails from people in the gold community now saying how ridiculous I am about when I talk about Bitcoin, acting like I talk about how great it is and how people should own a lot of it. I never say that. It's just the gold community. There's people in the gold community slandering me now. It's just ridiculous. I'm not going to name names anymore, but it's ridiculous. Could I do a presentation on HSBC and its future to be the next Lehman Brothers? Thank you for the comment. I don't think we have enough information yet to know. So there is, I highly recommend you follow Kyle Bass on Twitter. It's @JKyleBass. His Twitter is very spicy. There's a lot of China trolls on there who comment on there and harass him now. Harass all of his YouTube interviews too, with the dislikes and in the comment section, even Western names. But he just put out yesterday on his Twitter that I think the head of HSBC's China banking just quit for a new job. So just in the last week now, you have the CEO of HSBC. He either quit or he was fired. We don't know the real story yet, depending upon if you believe the rumors or not. And then on top of that, it was reported many places that the head of HSBC's China banking just jumped ship too and found a new job. And what I would say is now 2 higher people up in HSBC Bank have just left or gone from the company. So I would say there's smoke. We don't exactly have fire yet, but we do have smoke. We'll see what happens. So I think it's too early to do a presentation yet. Hey, thanks, Sean, for the super chat tip. And thank you. Oh, 2 Seans gave me super chats. One in Australian dollars. I think Australian dollars. You said mate, so I'm going to guess you're probably Australian. So thank you both, Seans, for the super chat tip. Things are going to get... Look, the overarching theme here, and I used to do Welcome to Dystopia shows. I'm looking for a new Welcome to Dystopia co-host. I haven't found one yet. No one's willing to commit the time. And also spend a certain amount of time with the current events and doing the research and the notes and stuff to be my co-host. But things are just going to get crazier. If you would have told me 10 years ago when I was learning finance and before the 2008 financial crisis and during the 2008 financial crisis that we would have people like Ben Bernanke now talking about 0 coupon perpetual bonds, issuing those, and we would have like Argentina issuing 100-year bond, and the talk of Japan now issuing a 100-year bond, and Japan now cannot even afford a 1% increase in interest rates, and all these governments now are trying to copy Japan. The channel is about investing in the economy. No, it's not finance porn. Investing in different topics about investing in the economy. Oh, by the way, guys, I created a new playlist for you for financial history, economic history and financial history, and there's a number of lectures in there. So if you want to go check out that, it's a playlist on my channel. Under videos, there's a playlist with some really good lectures from Jim Grant about the Great Depression in 1920, which was where the Federal Reserve actually did nothing, and it was over. That Great Depression was over in only 18 months, and there was a big recovery. So I have a number of good lectures in there talking about how the mainstream media analysis was wrong about the 1929 Great Depression. A great lecture by Dr. Robert Murphy from the Austrian School, the Mises Institute. Yeah, the bond market is acting like there is no inflation, but we know otherwise. And that's because people are only looking at the all the phony government economic data and all the phony government inflation data. And I don't expect that to change anytime soon. Would a dollar reset make a difference in the debt? It would make a difference on the dollar-denominated debt, but good luck trying to predict when the dollar reset's going to happen. And I think this is the trouble and the mistakes that these emerging market governments and emerging market corporations and emerging market banks got into. They were adamant that the dollar was not going to rally. They were 100% convinced. They didn't want to pay higher interest rates in their local currency. And they thought, you know what? The dollar has been weak for many years now. So once the Fed started QE, the dollar was very, very weak. So remember, the dollar rallied during the 2008 financial crisis. And then the Fed was worried about that and started doing QE. And then the dollar got very weak for a number of years. I think the dollar was weak until maybe 2013 or 14 before it started to fall. So the mistake these emerging market governments have made is they did not expect the dollar rally at all. And that's what got them in trouble. They took out an enormous amount of dollar-denominated debt, betting on a weaker dollar that their currency would appreciate. And in the short term, they expected that they were going to pay lower interest rates and that they were going to get a currency benefit. And really, they got the double whammy or triple whammy after that. The trade went the exact opposite way. If you can call an emerging market government or emerging market corporation deciding to borrow in dollar-denominated debt instead. And this is something that a lot of people in the gold community miss. A lot of them don't understand the difference between local currency debt and dollar-denominated debt. I've read articles and listened to hundreds of podcast interviews, and most of them don't make any distinction. Oh, I'm glad you like the financial history playlist. Yeah, I'm hoping to start doing a few more lectures on some of the financial history. I was maybe going to do a lecture soon about the history of paper money and how it started in China. So people in China are very familiar with their history. Chinese history is very commonly taught in school there. And so people are well aware that the Chinese dynasties, I think it was I'll have to read the article for which one. It was around 1200, I believe, that paper currency was first used widespread. So first, I think it was similar to like gold receipts in China, and then it switched to fully paper currency. They were the first country to do it, and predictably, the government abused the dynasty there. The government that was running things abused the paper currency, and they had hyperinflation. Normally, once you go to a full paper currency, it's very predictable that it will eventually collapse. The problem is most people screw up the timing, and a lot of people bet on the timing, and that's why you have this dollar-denominated debt problem. You had all these other countries and private corporations and banks outside the United States all betting on a weak dollar. And the dollar is not weak right now. Relative to other fiat currencies, the dollar is holding up pretty well. And that's because all these other currencies want to devalue against the dollar. I think ultimately everything else will be tried, and then we might get the FDR 1934 quote-unquote nuclear option of devaluing against gold. But unfortunately, I think the people in power will try everything else, which means a lot of really, really bad stuff prior to then. Is there dollar-denominated debt trading with rates? So there's Chinese banks that even sell dollar-denominated debt. So there's banks in other countries that do it, and some of them do it at the euro-dollar market. But on a relative basis, normally the dollar, and this is why people borrow in dollar-denominated debt outside the United States. First of all, normally it's lower interest rates, and secondly, they're betting that the dollar will be weaker than their local currency. But then they cannot get a bailout from their local government and their local central bank because the local central bank cannot print dollars. So if you're in Brazil and you were betting that there was the commodity rally in base metals, oil was going to continue, and you borrowed an enormous amount of dollar-denominated debt, and then it backfired, and then on top of that, commodity prices collapsed for a while, And commodity prices look pretty weak now too, especially with the slowdown numbers in China. Oil does not look good. Oil does not look good. The shale company stocks look bad. I've talked about this, I think, earlier this week. We may have, if the oil price continues to go lower, we may have a big bust in shale in the next 2 years, give or take. And there is nowhere near the demand to buy junk debt from shale companies and shares of shale companies. And if there are buyouts of some of these shale assets from larger oil companies, I do not expect big premiums for a lot of this stuff. Actually, the Saudis would benefit from a shale bust. Charmingly cynical. The Saudis would. They would gain more market share. The Saudis tried to bankrupt shale in 2012, 13, and 14. The Saudis tried to bankrupt shale then. The Saudis, I think, either maintained, there was no oil production cuts from OPEC, or they increased production, and they were hoping that once I was an oil analyst back then in 2013 for basically the whole year, and they were hoping that not cutting oil production would knock oil below the $65 support level, and they were looking at the research reports on the production cost for shale, and they did not expect the shale oil producers to be able to lower production costs. And the other part of the equation is they did not expect the shale companies to be able to raise hundreds of billions, if not over $1 trillion in junk bond debt and sell more shares to sucker pension funds and others. So the Saudis did try to choke the shale, to collapse the shale boom, and some of the companies did go bankrupt. You had a lot of the oil producing MLPs go bankrupt, like Lynn Energy and Vanguard Resources and a few of the others. But a lot of the shale companies survived. There was some that went bankrupt, but not nearly as many as most people thought. But in general, shale has been a big disappointment for investors. For most investors. There's some people that invested directly into oil drilling wells in shale, and they got their money out within like 6 months or a year, and they got their payback period and a return. But any long-term investors in shale, a lot of them have not done very well at all. Yeah, I talked about this earlier this week. There's a big divergence now between gold stocks and oil. And there's been 3 cases now since 1983. Go back and watch that episode. I explained it then. But the big divergence occurred in May of this year, end of May 2019. And the other times that this occurred was prior to the technology bubble collapsing and prior to the 2008 financial crisis. So that's why I brought it up, because it's a fairly interesting indicator there, the divergence between gold stocks, precious metal mining stocks, and oil, the big divergence. Oil is saying one thing, that the global economy is getting bad, so are base metals, and precious metals mining stocks are rallying. I don't know if the dollar will maintain world reserve currency status for the next decade. I would not set up, this is not financial advice, but in my personal opinion, I would not set up my portfolio based on that. If you do want to hold dollars, you should only hold them for maybe a couple years in basically, let me think of the right phrase here. You want to hold dollars for opportunity. So your dollars are going to be devalued the longer you hold them. But if you hold your dollars in case good stuff goes on, good assets go on sale to buy, say a good rental property you want to own for more income, or good stocks, good companies with good earnings, free cash flow, good dividends if there is a stock market crash, or let's say some of these really good gold mining stocks get trashed if there is a stock market crash. Let's say Franco-Nevada, which is over $80 a share, let's say it goes back down to 50. This is hypothetical. I would want to buy Franco-Nevada at 50 again, at $40 or $50 a share. They have enormous free cash flow. They've increased their dividend every year for the last 11 years, 12 years now. They run a clean balance sheet with little or no debt, and when they use debt, it's paid off almost immediately. So you want to have cash. You want to have cash for opportunity. You do not want to be in a lot of cash, though, for the long term. You do not want to have tons and tons of cash for 5 years, 8 years, 10 years. You don't want to be doing that. In the environment we're in, bondholders are certificates of confiscation, and so is cash. In a nominal value, your bonds may go up, but your bonds are going to be underperforming the real inflation rate. And I've explained this as nominal return versus real return. Let me tell you guys, most financial professionals and many hedge fund managers do not understand the difference between nominal return and real return. I know this because I've gotten in arguments with them on Twitter. Some of them do not understand this at all. Now, they can look at the financial statements of a company. They can do that well. They can make a lot of money shorting a stock, but understanding what nominal returns versus real returns is and how governments steal over long periods of time through inflation, they don't understand that at all. That is not taught in basic finance, or probably even at Harvard MBA, or any of those, elite schools with a MBA. You want my opinion on the Chase Bank credit card forgiveness in Canada? Yeah, so I talked about this in the Wall Street for Main Street Facebook group. A lot of people were in shock that JP Morgan Chase decided to do this. My educated guess is that JP Morgan doesn't want any exposure to Canada for that. So if you look at a lot of the charts and graphs, what you will see for consumer debt in Canada over the last decade is a big explosion in credit card debt, in home equity loans, in second mortgages, even third mortgages. So that is a big ticking time bomb in Canada, and a lot of that has been postponed due to higher and higher real estate prices. So that is making the same assumption that the US did from 2002 to 2007, that housing prices won't fall. And one of the guys who was featured in The Big Short from Michael Lewis, and also in the movie, the guy that Steve Carell played in the movie The Big Short, which was very entertaining. I read the book too, and I liked the book. The book was very informative, but it wasn't nearly as entertaining as the movie, seeing Margot Robbie in a bubble bath start cussing and talking about like mortgage derivatives. But I think the reason that JP Morgan did basically forgive that debt is they want to tell their investors that they have no exposure, little or no exposure at all to Canada, and they see Canada as a big problem. So the guy in The Big Short, I forgot his name, but he did an interview on Bloomberg in the last 8 to 12 months. It was on either a Canadian business TV or Bloomberg, I forget, and he said that his next big trade is short the Canadian banks. So my educated guess would be that JP Morgan wrote off all that credit card debt, that they think that there's no way a lot of it's ever going to be paid back, so they just forgave it now, which is a write-off for them. And they're going to tell their investors that, hey, we have no exposure to this Canadian consumer credit bubble when it blows up. That would be my educated guess. But there are a lot of Steve Eastman. Yeah, that's the guy's name. Yep, Steve Eastman. I almost said Steve Leisman, which is very similar, but Steve Leisman is like the token Federal Reserve brainwashed mouthpiece on CNBC. That he always, cognitive dissonance and confirmation bias and rationalization of anything the Fed says is good. Trying to maintain that the Fed is always in control, when we know the exact opposite, that the Federal Reserve is not in control at all. The Federal Reserve is losing control. Actually, Bloomberg ran a really good piece. Did you guys see that about the plunge protection team inside the New York Fed's trading desk in the last week? How multiple people at the New York Fed, their trading desk, were fired. That's part of the plunge protection team. I think the Fed is losing control. Other people don't. There's people that disagree with me. I think a lot of people inside the Fed, including the people at the top, there is a lot of panic, confusion, chaos, and desperation. Same thing in Japan. Same thing at the European Central Bank. The People's Bank of China has a lot more to worry about than their supposed 300 million ounce silver position. The People's Bank of China has a lot of other fires to put out. Plugging holes in the dam, plugging holes in the rowboat that's sinking. Okay, guys, well, that's it for right now. Everyone have a nice rest of your weekend. If there is any more breaking news, I will come back, I guess, and do a short little show. Okay, bye.